Stability is the most expensive lie on the Singapore exchange when it masks a 23% vacancy rate and a $57 million legal drain. The market cheers a deferred prosecution agreement, but the forensic reality is that engineered yields and public sector contracts don't fix a broken interest coverage ratio. Today, I am auditing whether your safe dividend blue chips are actually yield traps hiding behind headline-grabbing contracts. I've been watching the data on these hospitality and engineering plays for a while, and the numbers that finally made me sit up were the occupancy and gearing figures. It is one of those pieces where I had to run the math twice, because the gap between management's stability narrative and the actual balance sheet was that wide. Turning to the macro picture, the Straits Times Index is currently at 4,898.78, testing major resistance as volatility in the financial sector weighs on the heavyweights. The 6-month T-bill yield has dropped to 1.40%, down from 1.47%, a massive flight to safety with 19.2 billion Singapore dollars in oversubscriptions. Meanwhile, the 3-month SORA at 1.03% is compressing bank margins. For us, the T-bill collapse widens the REIT spread, but my standards don't move with temporary dips. The minimum yield hurdle stays at 4.7%. Turning to Seatrium, we have a major gearing alert. The recent legal finality regarding Brazil corruption offences comes with a price tag that the balance sheet hasn't fully digested. Seatrium will pay a net sum of $57 million to Singapore authorities under a deferred prosecution agreement. While the market sees this as closing a chapter, from a forensic perspective, this is a significant cash drain at a time when the company is already under pressure. The numbers for CPF show a gearing breach that cannot be ignored. Current debt to equity sits at 42.88%, 2.96 billion Singapore dollars in debt against 6.90 billion in equity. This is well above my 35% ceiling. When you compare this to a peer like Yang Zhejiang, CPF lacks that same order book to margin efficiency. Yang Zhejiang maintains a much cleaner forensic balance sheet without this kind of legal overhang. In a forward scenario, a 10% increase in operational costs from labor and materials could push the interest coverage ratio below the 4 times floor. The trigger here is global steel price volatility. For a 60-year-old retiree in Bedok managing an SRS drawdown, this is a yield trap. Capital recovery depends entirely on project execution, not the legal settlements you see in the headlines. The market is breathing a sigh of relief because the Brazil ghost is technically gone, but my forensic lens sees a different story. Paying $57 million is cash that isn't going to shareholders or debt reduction. At 42.88% gearing, there is no near-term path to correction. The order book gives hope, but the balance sheet demands caution. Until that yield clears the 4.7% hurdle, stay in the sanctuary of better capitalized peers. My classification for Seatrium is a clear avoid. It is not suitable for accumulation, gearing breach, and yield below hurdle. It is not suitable for transition or drawdown either. There is no reliable distribution floor, and capital recovery is too dependent on execution rather than balance sheet strength. Moving to CapitaLand Ascott Trust, we have a yield trap alert. Management uses the word stable, but 23% empty is not stable. CapitaLand Ascott Trust reported a first quarter occupancy of only 77%. This is a material breach of my 95% prime asset threshold, sitting well below the 5-year pre-pandemic average of 85%. If this forensic breakdown is useful to you, the single most useful thing you can do for the channel is hit subscribe. It takes 2 seconds, and it tells the algorithm that data-driven SGX analysis deserves to exist. Comparing CapitaLand Ascott Trust to CDL Hospitality Trusts shows that while the pivot into living sectors is directionally correct, those occupancy numbers haven't arrived yet. 77% occupancy is a structural failure for a prime REIT. If electricity costs rise by 10%, that 6.78% yield could face a 50 basis point haircut. For a 45-year-old HDB owner in Jurong seeking bond-like stability, CapitaLand Ascott Trust should be treated as a watchlist trigger, not a buying signal. Management speak aside, a yield built on 77% occupancy is a yield under construction. I won't touch a REIT with this occupancy gap when industrial plays at 98% occupancy exist in the same market. Stable distributions are only as strong as the heads on the pillows. The classification for CapitaLand Ascott Trust remains a watchlist trigger, not suitable for accumulation. That yield carries significant haircut risk. For transition and drawdown, it is wait and see. We need occupancy to recover toward the 85% historical average before income stability is verified. Turning to Boustead Singapore, we see a strategic neutral. They've landed a 400 million Singapore dollar contract, the largest in the company's history, for a public sector office complex. This isn't a today win, but it is a massive backlog win that secures the dividend floor for the next 3 years. For a 55-year-old PMET in Toa Payoh, this provides a genuine multi-year safety net. However, Boustead Industrial Fund is starting its race with a heavy backpack. IPO gearing is 37.9%, breaching my 35% ceiling from day one. They've entered a joint venture for 2 logistics facilities in Japan, but there is no established yield track record yet. The Japan development is a high-wire act. A 10% depreciation of the yen against the Singapore dollar would materially erode those projected returns. Peers like Mapletree Logistics Trust have a much deeper Japan track record and better capitalized sponsors. For a 50-year-old in Punggol, this gearing leaves zero room for error. Watchlist trigger, not a core holding. To be clear on the yield hurdle, my standards are non-negotiable. I use a 3.2% floor to ensure assets can withstand a return to long-term average rates. With a 150 basis point risk premium, that means a 4.7% minimum. Even though T-bills have dipped to 1.40%, the forensic floor does not move. The difference between a sanctuary and a yield trap is often decided in a single trading session. By the time this analysis reaches a free subscriber, the entry window I identified has already opened and often closed. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access. The forensic tools, the red zone watchlist, the full data tables, all at the link in the description. Don't be the exit liquidity for institutional players who have already priced these risks in. In summary, Seatrium's legal settlement is a moral victory but a cash loss, and 42.88% gearing is the barrier. CapitaLand Ascott Trust has a structural occupancy failure at 77%. Boustead's $400 million win is a great safety net, but their new fund is a high-wire act at 37.9% gearing. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.